If you work in finance or accounting, it's important to understand what we call accounting principles. In this video, we'll simplify the concept. The 7 primary accounting principles are: 1. Conservatism. Main idea: better be safe than sorry. 2. Consistency. Main idea: follow the same track. 3. Full disclosure. Main idea: truth and nothing but the truth. 4. Going concern. Main idea: to be or not to be. 5. Matching. Main idea: it's a match. 6. Materiality. Main idea: no one is perfect, we make mistakes. 7. Objectivity. Main idea: facts versus opinion and bias. Once you know them, use these terms knowledgeably and you should notice how finance becomes more manageable and efficient. For each accounting principle, we'll cover the main idea, its definition, and provide an example of how it's applied in real-world scenarios. Conservatism, also known as prudence, follows the idea that it's better to be safe than sorry. This principle requires companies to record anticipated or probable losses as soon as they occur, but to recognize profits only when they are actually earned, not when they are expected. How do we apply this principle? Let us walk you through an example. A recent major payment to a vendor was returned by the bank with the message "account unknown." Follow-up emails and calls have gone unanswered. So what should we do with the money? Should we record it as a gain since we can't pay the vendor? No, we should not, at least not yet. According to the conservatism, prudence principle, the liability must stay on the books. For instance, the vendor might be in receivership, and a bankruptcy lawyer could be working to identify all the company's assets during liquidation. This includes any accounts receivable they have from us. Now, let's move on to the second principle, consistency. The consistency principle ensures that a company maintains a steady level of performance by applying the same accounting methods and practices over time. This means transactions and valuation methods are handled the same way each year, providing reliable and comparable financial results. Example: a company must consistently use the same depreciation method for its assets over the years. For instance, if it chooses the mileage method to depreciate a vehicle, it cannot switch to the straight line method later, just because the mileage method turns out to be more costly. In other words, no jumping between, be consistent. Applying consistent methods will lead to accurate and comparable financial outcome over the years. By the way, this doesn't mean you can never change methods, but only when you have a solid, justified, and calculated reasons, especially when dealing with core significant transactions. Our next principle is full disclosure. Full disclosure means providing the truth, the whole truth, and nothing but the truth. All financial details related to business transactions must be completely and transparently disclosed, ensuring stakeholders have all the necessary information to make informed decisions. For example, under the full disclosure principle, the company must report risk in its financial statements and public filings. Failing to disclose this information could mislead investors about potential earnings and violate transparency standards. By being open about these risks, the company allows stakeholders to make well-informed financial decisions. Next, going concern principle. Going concern principle. The core idea is whether a company is financially healthy and able to continue operating for the foreseeable future. The idea is to be or not to be. It assumes the business will remain active and stable. The opposite would be facing bankruptcy or foreclosure. Going concern means the business is financially stable and will continue to be so, or at least for the foreseeable future. Imagine you lost a big customer and start to wonder whether outstanding accounts receivable will be paid or not. Can you continue operating when you are not sure if your sales team can bring in another customer of the same size? Do you in this instance assume that the business is going concern and produce your financial statement accordingly? Disclose your doubts about your business ability to continue as going concern. The answer rests on your judgment. Matching principle. This principle ensures that revenues and their related expenses are recorded in the same reporting period. For example, if a company pays upfront for a 1-year maintenance contract, it shouldn't expense the full amount immediately. Instead, following the matching principle, it should record 1/12 of the cost each month. Materiality principle. This principle sets a threshold where missing or incorrect information in financial statements becomes significant enough to affect the fair and accurate view of a company's financial health. Example: if a company records a $25,000 expense under cost of goods sold instead of administrative costs, the expense still appears in the income statement but is misclassified. Does this affect accounting accuracy? It depends. This misclassification is considered material if the amount is significant relative to the company's income. For a company earning $5 billion, this error is minor and wouldn't be material, but for a smaller company, it could be impactful. Objectivity principle. Accounting data must be based on verifiable facts, not personal opinions or biases. This means all financial information should be accurate, reliable, and backed by independent, unbiased evidence. Example: imagine a factory has a rusty, unusable machine. The manager believes it might still work, but the accountant, following the objectivity principle, advises writing off its value. This decision is based on a validated machine test confirming the equipment is non-functional, ensuring the financial records reflect accurate and unbiased information. That was all for accounting principles. Conservatism. Consistency. Full disclosure. Going concern. Matching. Materiality. Objectivity. Follow us for more knowledge in finance.